Hello, fellow RoboCapitals. Hope you're well. So we have a big day in the news today. The Fed comes out with their rate decision, and we had the GDP numbers that really surprised the market as well. And with the Fed's rate cut decision, they haven't done this since 1993, at least what they did today. So let's dive right into it. The big news of the day wasn't necessarily the rate cut or pause or hike. It's more so what was happening internally with the Fed. That's something that's more, let's just use the word unprecedented, or like I said, hasn't happened since 1993. Let's dive into this and you'll see exactly what I'm referring to. Let's see. Do we have the screen share, Josh? I think we do. So we go over to Barron's. Two Fed governors dissent from policy call for first time since 1993. As you can imagine, it's Waller and Bowman. They're the ones that have been a little more dovish. And I get it. I think they're trying to jockey for position for becoming the next Fed chair because they know that Trump is very dovish. So they want to seem like they're ready to play ball. And also, this Barron's article points out, let's see, let me see if I can hide this. When everyone knows that Jerome Powell's gone in May, if not sooner. And so what they're pointing out here, I just highlighted, is at the end of their tenure, their soft power begins to diminish. Okay. I mean, maybe that's a part of it, but I don't really think that explains what's going on because this has happened before. And this has happened many, many times since 1993, as far as the Fed's tenure being capped. They know they're on their way out, and it hasn't created this type of dissent before. So why now? And so if I've got to lean one way or the other, I'm going to say that probably the biggest reason they're doing this is because they probably are dovish. I don't know, they're just flat lying to get the position. They're just probably making their dovish views a little bit more. They're probably vocalizing their dovish views a little bit more than they otherwise would, just to kind of wave the flag to Trump, saying, "Hey, look at me, look at me, look at me. I'm your guy, I'm your gal." But this is big news because when you consider this with what Powell said, it overall you could take it as dovish. Now, did interest rates go down as a result of this being kind of a dovish pause, if you want to look at it that way? No, actually, they didn't. Interest rates went up. And this is the second thing that really surprised the markets today, really surprised me. But honestly, it's even more bizarre than what we're seeing internally with the Fed. Let me show you what I'm referring to. First and foremost, we'll look at interest rates. Start with the 10-year Treasury yield. And as you can see, it's up. Look at a 5-day chart. And I mean, not up dramatically today, only up 4 basis points. In fact, it was up more than that. And then it came down a little bit. And over the last 5 days, it is down overall. But we definitely got a pop today, this morning. I think prior to the GDP report coming out, that's the big news we're going to talk about next. It was down at 3.2, then it shoots way up, then it comes out when the Fed makes their decision, a pause, kind of a knee-jerk reaction, and then it starts to sell off again, which is where we are right now. So interest rates way up, and I kind of let the cat out of the bag there. That was because of this GDP report that we had come out this morning prior to the Fed's interest rate decision, where they did pause. But what the big news was that internal kind of civil war within the mutiny that's happening within the Fed, if you want to call it that, the soap opera that is this dissent, the biggest kind of, what would that be? That would be the biggest kind of internal fighting they've had at the Federal Reserve since 1993. That in and of itself is a big deal. It is. But going back to my point here with yields, it's all about GDP. So let's go over to the Market Watch calendar and see what the expectations were. And the expectations were for 2.3. So remember, last quarter, the big news was it was a negative number, a negative 0.5. But remember, that was really weird because we have the tariffs and we have this huge trade deficit, which is a negative on the GDP number. And we had big inventory builds, which are a positive, but all of this was front running tariffs. So there's, what was really happening? It was all kind of just noise. You could tell that no matter how much the noise, a negative 0.5 is bad. But what was the real, what was the signal there? It was very difficult to tell. So now we have this 3% number, which at surface value or at face value at surface level, this looks fantastic. This is great. Look, the market was expecting 2.3 and we got a 3%. So this is why, in my view, interest rates went up to the degree to which they did. We just saw a CNBC chart, but there's a Market Watch chart for the 10-year Treasury yield. And this is this move up from 3.2 straight up to, call it 3.7. So a quick, bam, 5 basis point move, which once again proves what I say on this channel and on social media all the time. What drives the long end of the curve? Is it supply expectations? In other words, future supply of treasuries? No. Every single time that you see a headline that drives interest rates significantly up or down at the long end of the curve, it's always about growth and inflation expectations. So we had a positive or a beat with GDP, kind of shocks the market. Whoa, we were expecting 2.3. We got a 3%. What happens to growth and inflation expectations? They go up. So what happens to the 10-year Treasury yield? It goes up. So anyway, I'm not going to beat on a dead horse here, excuse me. But I always have to get that because that view is so prevalent with experts, amateur, everyone in between, whether it's on CNBC, alternative media, social media, it doesn't matter. It's all about supply. Supply is the number one driver of interest rates along the curve. That's why the debt's unsustainable. The deficits are blowing out. The debt's blowing out. There's not going to be any buyer for the treasuries. And we're going to be supplying all these additional treasuries. So regardless of what's happening to growth and inflation expectations, even if it's going down, it doesn't matter. The interest rates at the long end of the curve are going to blow out. We're going to lose control of it because we're going to get this deluge of supply and there's just not going to be enough demand. So I call that supply expectations. That never, ever impacts yields. And if you guys watch my videos a lot, I go into mechanically why. It's not just because it hasn't happened in the past. That's not my view. It's because of the mechanics as to why it has or why it hasn't mattered in the past. And if we continue with a monetary system that includes those mechanics, we should expect the exact same thing to play out, which, again, here's a perfect example. Yields moving not on supply expectations, but growth and inflation expectations. So let's go over to this GDP report, which, by the way, the Wall Street Journal is calling it the weirdest GDP report ever. And that's actually saying a lot because the last GDP that we got was pretty weird. All right, you'll have to forgive me, guys. I got a little bit of a cold here. So let's see if I can zoom in. And as you can probably tell, I'm traveling, speaking up at my good buddy Kenny McElroy's event, Limitless, this weekend. Going to be here, some good buddies, Snyder, Brent Johnson, Rickards, I think is going to be here. So that'll be a lot of fun. Okay, so weirdest GDP report ever. Remember, this came out at 8:30 this morning when we saw the big spike in yields prior to the Fed's decision where they revealed the big drama internally at the Fed with the dissent. The economy grew 3%, but mainly because imports collapsed. Okay, so let's just get the quick and skinny here. If you think President Trump tariff ructions, I don't even know what that is. Don't affect the economy. Take a gander at Wednesday's report for a second. Okay. So this is just going to be, look, I voted for Trump. There's a lot of things that he does that I don't like. I've made my opinion very clear on this channel, but I cannot stand it when the media, right or left, literally the only reason they do a story is not to report the news. It's just to bash on Trump. It's like, okay, I get it. You don't like Trump. I get it. You're blaming him for every single thing that you possibly can. But can you please just give me the data? I mean, please. Jeez. So on that note, let's go over here where we can actually get some data without all the crazy editorial. We'll just go right to the report. This is what I should have done to begin with. This is the Bureau of Economic Analysis. So right here, they've got Q2. That's where we are right here. This is 3%. And again, the expectations were for 2.3%. Last month, you can see this decline of 0.5. So you got to add, what on earth is the discrepancy here? Now, the good thing about the GDP report is it's pretty straightforward. There's only like 4 levers that you can pull. It's like the trade deficit, investments, inventories, and basically consumption. That's it. So let's go down here to this where they kind of get into the nuance of this GDP report. So that last chart we saw was just comparing the last few quarters of GDP as far as the reports overall and aggregate total. This is breaking down today's report that made up that 3% total that surprised the market to the upside. So overall change, that's orange. We get that, 3%. Consumer spending. So that went up a little bit, but definitely not to the degree to which would warrant a 3% increase in GDP. Look at investment. Investment way down, way down. So when you look at that headline number, it Trump and the administration, and it's just natural by any administration would do this, is they would just point to the positive. But when you look beneath the hood, you're like, I don't know. I mean, the whole point of MAGA is to bring investment back to the United States and to bring the jobs back and to do all these things internally for the economy that's going to lead to better, higher paying jobs, more productivity, more goods and services, more GDP, higher standard of living, et cetera, right? Well, one of the catalysts there is going to be investment. So you don't want to see investment negative. That's not good. So I stuck up for Trump before. Here, I'm going to kind of point out or highlight that this is in the no bueno zone right here. Government spending, we would like that to be a huge negative, even if that meant negative GDP. But although that would be better long term, short term, that's still going to negatively impact the economy, as much as I hate government spending. So then you look at the exports, imports, and this is where we get, obviously, the trade deficit. So if you have and just to be clear, the bigger the trade deficit, the bigger the negative to GDP. So that's a subtraction from GDP. Where if you have a trade surplus, that's an addition to GDP. All right, because what we're trying to do is trying to figure out the productivity of the domestic economy. So if you're exporting $500 billion worth of stuff, that stuff isn't going to be purchased here where it would be picked up in consumption or in inventories or something like that, where it would, and I believe that inventories are also a component of investment, just to be clear. So if you had that $500 billion of exports, that's not going to be picked up in consumer spending or investment, but that is something that was produced in the United States, so you'd have to add that, right? Where if you have 500 billion worth of imports, or let's just say that the net trade deficit was 500 billion, that means we're importing 500 billion more than we're exporting, or we're importing 500 billion more than we're exporting. I'm sorry. That would be a draw or a negative. Why? Because that would be picked up as a positive 500 billion in consumption or inventories, but we didn't produce that here. So that's kind of the rationale as to why a trade surplus is going to add to GDP, or a trade deficit is going to subtract from GDP. So we look at the import total. Well, first let's look at exports. Pretty much flat, a little bit negative. So that's going to detract, all else being equal, that's going to detract from GDP because we would want the exports higher, like I just said. But then imports, which also going to detract from GDP, skyrocket way up. Now, this doesn't give us an aggregate total, but it just shows us the addition that this was to. Let me rephrase that. The imports were way down. So when I said way up, I meant the addition to GDP. Sorry, I'm kind of confusing you guys here. Again, got to forgive me, got a cold here. So the imports were way down in aggregate total. Imports way down, which made a huge jump up in the GDP. And this is kind of like a counterbalance, right? So you have everyone front-running tariffs, that takes the imports way down, which adds to GDP. And then the next quarter, everyone's already front-run them. So then there's not as many imports as there normally would be, which is this massive add to GDP. To get a clear picture, it's almost like we got to wait until Q3 when the dust kind of settles, so to speak. So I think there's and now this did surprise me from the standpoint is I thought the GDP number would be sub 2. I thought it would be possibly even flat or negative. And the reason is because when I saw the deficit numbers come out, I didn't see them decreasing to a point that would lead to this much of an addition to the GDP. Now, maybe the last few, they must have really done something miraculous as far as the reduction of imports, because what I was seeing, the trade deficit wasn't really snapping back. It was just kind of normalizing. In which case, if you had a normal trade deficit along with, 0.08 in government, this huge negative in inventories and investments, and just a slight beat or slight increase in consumer spending, you probably would add closer to maybe 1%. I mean, I guess I can do the math here. You've got maybe a positive 1. You've got a pause. Yeah, you actually would have had probably a negative here, assuming that this would have been flat. So a lot of noise here, guys. That's the bottom line. A lot of noise with this GDP number. And I think the main takeaway is, number one, the Fed is definitely divided. We're seeing kind of a mutiny there. And this may lead to a more dovish Fed in the future. That's probably the way the market is interpreting it overall. And then I think the bigger news here is the beat on GDP. But then when you look underneath the hood, it just gets real messy, real noisy. And I think you could look at this as a positive if you just look at the 3% number. But I think you could look at this as a negative as well when you kind of look beneath the hood and say, wow, investments were terrible. Consumer spending, not that great. Government down, which long-term is good, short-term not. But then when you look at the trade deficit, pretty much it's all about that. And the BEA kind of reiterated that right here. The increase in real GDP in the second quarter primarily reflected a decrease in imports, which are a subtraction from the calculation of GDP. Okay, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.